Now recorded. Okay. So, Cheryl, I wanted to talk before we go over the reverse mortgage stuff. I wanted to talk, what do you know and what do you think about when I say we're going to do a reverse mortgage? I'm kind of curious, what are your thoughts and preconceived notions about it?
I know that things have changed from when they first came out, and I wouldn't have touched them with a 10-foot pole.
Okay.
And I know that I don't know enough about it,
Yeah.
which is why I wanted to attend this
Okay.
session.
Okay. And I'm gonna try to limit how much you talk, but why would you say you wouldn't have touched it for a 10-foot pole? What makes you say that?
Expensive fees,
Okay.
and also concerns for the heirs.
Okay.
If they're going to get burdened with something, because I've heard horror stories about that
Okay.
from some of the early adopters.
Yeah. Okay. All right. Any other big objections that you've heard or you had yourself?
Um, Not really. I just know that my tendency is no, but I also know that what I don't know could change that. So I always like to be educated.
Okay. You got it. Well, let's just jump in here and other people may or may not jump in, but I've come upon reverse mortgages again for a couple of different reasons. One is about, I guess it was maybe last October, Guild actually bought a company out of Colorado called Cherry Creek Mortgage. And they're the number one reverse mortgage company in the country. And now we brought that process in-house. And so I don't like brokering loans very much, but if I can do the loan in-house, I started learning a little bit more about it because it's easier. I can provide better service. So that's kind of how I started thinking about it again. The other thing that really started to have an impact for me was that I have a lot of seniors, right, 62 years and older, that are calling me. They want to move, especially maybe out of the Bay Area. And two things I started to notice. One is perhaps they were on Social Security and fixed income, and they just can't afford the new home that they want to move into. Or they're coming out here from the Bay Area. They've sold, a house in Fremont for $2 million, and they're spending $1 million in cash to buy a house because they can't afford it otherwise because of the monthly payment. And I just thought, well, that seems like a crazy amount of money to put into a home without looking at other options. So I started looking at the reverse mortgage, and I have heard as well all of the all of the what am I trying to say? All of the objections that people have had as well to reverse mortgages, which would be what happens to the heirs. I think that the objection really is there's a sense that you don't own the home anymore. The bank owns the home, and that when you die, then the bank would take the house and the heirs would get nothing. I think that's the idea from the kids. And then in terms of expense, the funny thing is they used to be a little bit more expensive. There's no question about that. The reason is that because there's no mortgage statement each or payment each month, normally when you make a mortgage payment on a regular traditional mortgage, you actually part of the payment baked into everything is the cost to service the loan over the length of the loan. That's one of the things that Guild has done that's made us remarkably profitable during these times, is that we have like a $7 billion servicing portfolio. But in the case of a reverse mortgage, they take and they kind of estimate all of the fees to service the loan over a period of years, and then they add that and kind of front load in that. So that's where you got this sense initially that there were no or they were very expensive loans. But now with the cost of a regular traditional mortgage, I can show you the title and escrow fees are basically the same. There is an FHA or origination fee, but the fees itself are kind of comparable to just a regular forward mortgage at that point. So I'll go over some of this and show you a real live example of what something looks like. And then I think that maybe it might change the way you think about it. So let me go ahead and share my screen, and we're just going to go over some of the basics here. Hang on one second here.
Also want to hear about the timing,
Okay.
because I don't know anything about it. If a reverse mortgage takes longer
Yeah.
than if my buyer is using it, I
Hmm.
need to know about that for
Yeah.
writing offers.
Yeah. It doesn't take longer at all. You might, since we service it own, I just closed one, I think, in about 22 days. The steps that the borrower needs to go through to get the loan set up really would be done at the outset once you're in contract. The biggest delay, if there's going to be one, is that every borrower has to have a counseling certificate. So I'll go over that, but once you're in contract and we're ready to go, it should not be any longer than a regular transaction. Okay, so can you see my screen here? It says reverse mortgage for purchase guide.
Yes.
Okay, so a couple things here. So the benefits of for reverse. So unlike a traditional mortgage, right? We have you can buy a home with no. What I like to highlight here is no mandatory payment. A reverse mortgage is the best way to think about it is that it is like a glorified line of credit, a line of credit that is secured by FHA. It is an FDIC insured loan. And so it's like a line of credit. The only difference is that you're not required to make a payment. I have people that are in these loans and they still are making a mortgage payment. And I'll show you the benefits of actually making a little bit of a payment here in just a little bit. But just because you have a reverse doesn't mean you can't make a mortgage payment, just means that you're not required to make a mortgage payment. Softer qualification requirements. Basically, because there's no required mortgage payment, you only need to qualify with being able to show you can cover taxes and insurance. So, you buy $1 million home, you have a $500,000 loan. Instead of it being a $7,000 or $8,000 a month payment that you have to qualify for and make every month, you just need to be able to show you can cover taxes and insurance. Every single one of my clients that I've closed a loan for has only had to provide their Social Security benefits, and that's been enough to show that they can cover everything, and the loan goes through and gets approved. Okay. Competitive interest rates and fees, they are adjustable. They will go up and down. I'll show you that in a second. You can make, like I said, the payment if you want. There's no prepayment penalties. Depending on your age, you don't necessarily have to put down a massive amount of money, and will absolutely allow you to buy a home with less money out of pocket, so you don't have to spend all of the cash that you receive maybe from another sale. You don't need to make a monthly repayment unless the borrower moves, the borrower sells, or the borrowers pass away. So this is for a primary residence only. And so long as you live in that house as your primary residence, you do not need to make a payment. So it gives seniors, especially on fixed incomes, a lifestyle change. Instead of having to continue to work or using a huge amount of their fixed income towards just maintaining the mortgage payment, or perhaps taking money from another account, 401k or IRA, and depleting that account. All we're going to do is just use the equity in the property to allow them to save those funds for other purposes. Okay, so I'll go to the inheritance in just a second.
So yeah, because I lost my husband, I'm very sensitive to the spouse that's left behind, and that would be another concern as well. So I'm sure you're going to cover that.
Well, it is. I mean, because the spouse that gets left behind, so long as they are still living, I mean, that'd be interesting if someone was, whoever's on that loan. Well, if you're married, both borrowers need to be at least 62 years of age, so you would always qualify for it. Once someone passes, or if you were to use the reverse for a purchase, it's just going to, I'm going to getting a up. It's just going to defer which funds that you would use. Okay. So, qualifying criteria. There are really two ways to do it: loans under $1 million and loans over $1 million. Over $1 million, the terms change. It's not an FHA loan anymore. So it's a private loan. You can, the two things to highlight is you can be 55 years of age or older. So there's a lower age threshold, but you will see the interest rates will be higher. The difference would be like it's going to be probably around 11% right now. So a much higher interest rate. And the reason why is that there's no government guarantee. So now you have a private company that is going to be issuing the loan. And because without the FHA insurance, they're going to require a significantly higher interest rate, as well as probably less money that a borrower would be able to access. So most people do under $1 million. It's just going to be basically conforming limits. So you can see you got to be 62 years of age. You have to be 62 years of age or older. The home has to be a primary residence. There are no exceptions to this. You have to pay the taxes, insurance, and HOA, and this can be impounded, so that you can set the loan up so that the loan the lender will impound in a very specific way so that they will pay for the taxes and insurance. The base income and qualifications, again, to kind of restate, is super easy. It's just basically showing Social Security, pension income. You could do asset distribution, just enough to cover the taxes and insurance and HOA on the property. So really, really turns qualifying for a more expensive home on its head, much easier. The question you had to start, Cheryl, about the time frame is that borrowers have to attend a HUD counseling. The way I set it up is at pre-qualification stage, we give them a list. I can't even tell them which company to call. I can just provide a list of, like, I think it's like 10 or 11 counselors. The borrowers have to call. They have to schedule a time. They have to go through, it's like 20 or 30 minutes, a counseling class. So basically a third party is going to talk with the borrowers about the reverse mortgage, make sure that they go through all of the steps and they understand the process. This is one big, huge change from the 80s where there was no regulation. I cannot do anything on a loan. I can't disclose an application. I can't order an appraisal. I'm really not even supposed to push out a pre-approval letter until that borrower has a signed and completed and dated what's called a HECM certificate. So this is really set up to protect the borrower so that lenders don't take them to the cleaners, right? They're trying to change the perception of what a reverse mortgage is, that it's not just people getting, raked over the coals. So that would be where things could take a little bit of time, depending on which borrower, who the borrower is, whether they're diligent about scheduling a class, and then how far out that class might be. Usually it's a week or so at most. Okay. So interested in a reverse, but not yet 62. I'm going to gloss over this one. This is a loan that is way more expensive, and it's really for jumbos. So it's not something that we run into very much, but there are options if you are under 62. So
if you have somebody who there's a big age gap, there's a 22-year-old can't get, and whose husband is 80, you cannot do a reverse mortgage, right?
That is correct. You have to, the minimum age would be 55.
Gotcha.
The one thing I like to point out is here, this applies for all mortgages. These are non-recourse loans. So unlike a line of credit, or in certain jurisdictions, doesn't really apply here in California, we are a non-recourse state. So one of the things that people are always fearful about is they're going to lose their house. Well, just like a regular mortgage, if someone were to pass away or move out or sell the house, let's just say the unbelievable actually happens, and you have a house that you buy for $1 million. The max you're only going to be able to borrow is $400,000. Okay, so there's a huge amount of equity that you're going to have. But let's just say the house goes upside down in value. Well, just like on a regular mortgage, either the person, you could let the house go to foreclosure, or you would go to sell it. And if there is owed more on the property than the house is worth, then the bank takes the loss. This is a non-recourse loan, FHA run, just like a traditional mortgage. So one point is that by law, they're not going to lose, the heirs will not have to make up any differences. Part two would be that the way, and I'll show you in a second, the way they set these loans up is that it's almost impossible that you could be upside down, because they're going to maximize what you can borrow based on a life actuary table. So the younger you are, the less you can borrow. I just sent out a quote earlier today to somebody. They're buying a $1.9 million house in Napa. They are 69 years old. Their max loan is $378,000. So the notion that the house is going to go back to the bank is really just something that it's not a reality anymore of the way these things are regulated. Okay. So contract essentials for you as a real estate agent. There is an FHA mandatory clause and real estate cert required. Ordinary and customary fees, split them as you want. Lender credits and seller credits, this is incorrect. I'm getting it changed. There was a rule change about 2 months ago. You can have lender credits and you can have seller credits and concessions up to 6%. So regular FHA rules apply. So for your purposes, you write the contract up, split fees, everything is normal. No change to you from the contract side.
So a reverse mortgage is an FHA mortgage.
Yes, it is FHA insured and FHA requirements apply. Okay. For new construction, we're just a couple of things. We have to have a appraisal ordered after the home as 90% complete. Sometimes on a regular loan, we can get out there a little bit earlier. And then obviously a certificate of occupancy. But again, that's all normal. It's all normal stuff from writing up the contract. Okay. So the down payment. So the down payment is going to be very similar as well, like any other loan. Acceptable down payment sources would be proceeds from the sale of the house, money from existing home or accounts, or documented gift funds for family, kind of like an FHA loan. Unacceptable would be cash, unsecured financing, personal loans, undocumented gifts, and borrowed money. Again, should sound very, very similar to a regular mortgage. There's really no difference except in the manner in which you make a mortgage payment. Okay. So let's compare a couple of options here for mortgages.
Let
So
me ask one question before,
Sure.
because it's been in the back of my mind. If someone has a home, they can't keep that home as a investment to buy the new home.
Sure, they could. You could turn it into a rental. You would just have to, just like any other home, if you're going to rent it out, we show a rental check and a lease agreement. And the new home that they buy, we just need to put down the money to get in as a new reverse purchase, and that would be their primary residence.
Okay, interesting.
Okay.
All right, thanks.
So here's the big thing that people, I think is going to make a big difference for people. So on a conventional mortgage, over here, your loan to value is somewhere between, let's say, 80 and 95%. Now, you could always put down more if you wanted, but most people are going to put down, let's say, 20%.
Mhm.
And that means that they have taxes and insurance, and then they have a mortgage payment on whatever the loan amount is, which could be $3,000 or $4,000. On a reverse mortgage, I have not seen anything go above 50% loan to value. Again, they are going to set this up so that, I'll show you in just a second. They're going to set this up so that in order to even get the loan through, you're putting down a massive amount of money. It's not going to be all of it. It's going to be way better than putting it down for with cash. And I'll give you some ideas on that. But the going into it, the heirs should understand that there is a massive amount of equity. So let's say it's 50%, and property values go up by 5 to 10% a year, and they're already at 50% equity. aside from the notion that you should never bank on your parents' inheritance, it's just inconceivable that property values would turn upside down, even during the Great Recession, right? You remember that? We were only down like 27%. So it's just not really going to happen. Now, ownership, 100% ownership. Again, the bank doesn't own the property. The borrower owns the property, is the title owner. There's just a mortgage on the property. That's all it is. These are non-recourse loans. Okay. The reason why it says recourse over here for conventional, because there are some jurisdictions and states that are recourse. But again, the only security interest that the bank has in the property is the property. There would be no monies owed by anybody if the property sells and more is worth, or there is more owed than the property is worth. So it's FHA. It's very, very similar. The interest rate, I'll show you in a moment, is a fixed rate or a variable rate option. I'll show you the differences between that. So the buying.
Now that 2% mortgage insurance, is that that's a closing cost? Is there a mortgage insurance paid monthly?
There is a little bit of mortgage insurance paid monthly as well. You're not going to pay it. Remember, it just gets added to the loan amount. But it is an FHA loan, so there is a 2% mortgage insurance premium. And what's happened is I'll show you in a second. They don't add it to the loan amount. What they do is they say, okay, you're 65 years old. You are buying a $800,000 house. We're going to say it's going to cost this much. You have mortgage insurance. You have servicing fees. They're going to back all of that. And they're going to say the max you can borrow is $300,000. So you're not going to actually pay for it. They're going to include all of these costs over time, and they're going to reduce what you can borrow. So there is always this spread. Everyone gets paid, and you don't go upside down in the property. Okay. So comparing to the borrowing process, non-reverse mortgages average 30 days to close. We can do with ours in 20 to 25 days. Like I said, because the borrowers have already been counseled. Once when I set the loan up, I grab their basic information. I've already pushed it through to our system. Once they have the counseling class, they get into contract. All I have to do is process the loan, get the appraisal, and it's done. It is way less time consuming than a normal process. And the number one reason is there's just less paperwork from the buyer, because there's less that you need to qualify. Now, I will give you a caveat that we are dealing with seniors. Sometimes you're going to run into seniors that need a little bit more time to process the information. Sometimes you're going to run into seniors that are not very tech savvy. So I try to meet with most of my clients in my office up front. And then when the loan application is there, because that gives them a little bit more comfort and a little bit more trust, I invite all of the family in so that they can learn about the program. They can get to know me, that we're not going to rip people off. And so sometimes that can add a little bit to it, but I would not think that you need any more time, most likely less. Okay. All right. So conventional mortgage and reverse mortgage, you're going to see the only things that are different is at the pre-qualify stage. We're going to do the counseling class, still income and assets, still underwritten like normal. The borrower is going to sign the contract. We're going to open up escrow just like you would on a normal process. There's going to be a few different forms at the very, very end and what they're called for the borrower, but the nuts and bolts are the same. They're going to have a closing disclosure that they'll sign, and everything will obviously be disclosed. And then you're wiring funds. So the process for you as a real estate agent is going to be virtually the same. You won't really see any differences at all. Okay. All right. So here's some interesting things that I like to talk about why I don't think buying with all cash is necessarily the best idea. So here's two examples. Let's say you bought a house for $500,000. You pay $500,000 in cash. You live in the house. You live in a $500,000 house, right? You paid 100% cash, and there you go. You're in and done, and you don't have a mortgage. Okay, that's fine. You're just responsible for taxes and insurance. Whoops. What if instead you did 50% cash and you did a 50% reverse mortgage? Here's where I want to have people to start thinking about the mortgage and the equity in their house as a bucket of assets. So imagine you have, as a retired person, most likely you have Social Security. Hopefully they're not working anymore. Maybe they have some savings. Maybe they have some stocks. Maybe they have a 401k or an IRA, and then they have the equity in their house. They're all different buckets of assets, like different buckets of apples. You got to eat an apple, right? You have to live off the apples. The question comes down to is, which is the best basket of apples to use? Okay, so here's an idea. If you spend all that $500,000, it's in, it's done. You have a house that has no mortgage on it. It will appreciate whether or not you have a mortgage on that property. Those are two mutually independent things. So you've used all the $500,000. Well, what if you put $250,000 down, or in this example, excuse me, you're going to buy a house for $600,000. You're going to put $300,000 down. You're going to have a 50% loan to this. The example doesn't make sense. I don't know why. I got to change that. Let's do 500,000 and 250 in cash, right? You're going to put down 50%. Now you've retained $250,000.
Right.
You have a mortgage on the house that you have the option to make a payment. You can, you're not required to. That property still appreciates at the same rate, regardless of how much the mortgage is. But now you have $250,000 that you've retained in cash. Possible uses for that money. Oh shit, money. Put it in a savings account. You could cover incidentals. You could go on a trip. You could take that $250,000 and you could invest it somewhere else. So now that money is actually earning money. So instead of using, because if you put all the money and cash on the mortgage, now you don't have access to that money anymore. Gotcha. Right? So what I start thinking about, especially when I'm talking with the kids, is listen, kids, I understand you don't want to use the equity in your parents' house because the perception is that you're going to inherit this house. And if that loan amount goes higher, you're going to have less money. Okay, let's assume that's the correct. I'll give you that. All right, that is a concern. However, what's your mom going to live off of for the next 15, 20 years? Or do you want her to work? Right, that's stressful. If you don't want her to work, is Social Security enough to give your mom the quality of life that you want to give her? If she has money in other accounts, okay, let's talk about a 401k account. Well, you could use the money from the 401k. At certain times, you're going to be forced by the IRS to take withdrawals. What happens to an 401k account, let's say it's $1 million and it's earning interest? If you're forced to take principal payments from that 401k, the account balance reduces. Therefore, the amount of money that it could generate on interest reduces as well. So you're actually taking money out of an asset that's appreciating in value and you're using it for something else, and you're restricting your own ability to have that account continue to earn money in the future, right? What do really, really rich people say? Don't touch the principal. So by not having your mom use that 401k, that's money that you would have. You still have an appreciating asset on the house, and she has a better quality of life. So if she makes a mortgage payment, she'll have a lower mortgage. But if she's pulling money from a 401k, you're not getting that account. Or God forbid, you're actually making a payment to your parents. So do you want to make $2,000 or $3,000 out of your own cash flow for your parents? Or does this make sense to use the equity, a massive amount, add a little bit to the mortgage payment over time, and it's still an appreciating asset? Just different ways to think about it that don't create that sense like, oh, my parents are going to lose their house, because that's just not really the case. Does that make sense?
It does make sense, yes.
Okay. So I'm going to show you one other let me get through this. I'm going to show you one other thing. Okay. So borrower's obligations. So pretty basic. They got to maintain homeowners insurance, keep the property in good condition, live there as their primary residence, and needed home repairs must be completed before closing. Sound like a regular mortgage to you?
Who decides on what the needed home repairs are?
Right. Well, this would just be if we get if we get conditions on the appraisal, it is an FHA appraisal.
Okay,
Just like normal, it would have to be fixed prior to closing.
gotcha.
So 10 either steps, meet with me, schedule the counseling, complete the loan application, which is so basic. I did one, it took me 5 minutes earlier today. All I need to do is put in name, address, date of birth, what's the loan they want, what's their income source, and the whole thing gets populated in. Get into contract, you order the appraisal, the loans can be approved virtually immediately because it's already in the system. Loan docs get sent out, the reverse mortgage is funded, title is transferred from the buyer or the seller to the buyer. So that's a big one. The bank doesn't own this property. It's the same thing as a regular mortgage, but the form and timing of the interest payments on the loan is changed from every month to at the borrower's leisure. Okay. Borrower moves into the home. So important information. There's one thing on here that I like to point out. The interest isn't deductible until all or part of the loan is repaid. Now, some people kind of lose their mind over this because they think that they're going to lose that precious tax deduction, but that is literally the tail wagging the dog. We don't ever want to buy a house for the benefit solely of a tax deduction. It's there. You're just not going to get it until that loan is paid off in full, which of course is going to help the heirs, right? They're so concerned about how much money that they're going to have. Okay, so I want to show you something that's really pretty cool. So this is, I probably should have blacked it out, but this is Robert's loan that I did for him last year. Now this happens to be a reverse mortgage, but a refinance that we did, but the mortgage statement is going to look basically the same. So when it comes over here, you're going to see that the borrower owes about $314,000. And you can see what the interest rate right now is at 6.625%. It is an adjustable rate loan. So it just gives all that information. And you can see that every month, let me scroll down one little bit. Every month that he doesn't make a payment, then the interest is $1,726, and he has the mortgage insurance, and that is what is added to the loan amount. Okay. Now, by the way, let's say it's $2,000 a month that gets added to the loan amount over a 12-month period. That's $24,000. It's not that much money. And let's just say the guy, let's say it's $24,000. I don't know, times maybe 10 years. Just so you know, I don't know if it's on here. His house, by the way, appraised for $1,080,000. Okay. So his loan amount right now is $314,000. If he didn't pay anything over the next 10 years, his loan amount will only go to up $240,000. So owe $500,000, and his house will probably be worth $1.5 million. Okay. Now here's the thing that I fell in love with about reverse mortgages. The interest rate right now is 6.625%. Now, over here, it shows that his original principal limit, the most when I did this loan for him last year, that he was able to access, he only needed 314, but because of his age and all that, he actually could access $433,000. So that would have been, he had a line of credit available of about $125,000. Okay, you see that, the difference between 314 and the original principal balance?
Yes.
Okay. Well, now look at the current principal balance. It's gone up $33,000. So he can actually now tap into an additional $33,000. Now, how did that happen? Here's the craziest thing about this mortgage. The amount of money that he left in the account, that $120,000, grows at the same rate as the interest rate that gets put on the loan. So while he is paying 6.6% on the mortgage of the amount that he's owed, any line that he hasn't used, because this is an FHA loan, it's an FDIC insured loan. They have to pay interest on the unused credit line. So his credit line has actually grown at 6.6%.
Well,
I don't know about you, But where do you go to put money that's going to give you 6.6% guaranteed and FDIC insured?
That's pretty awesome.
That's really awesome. So now we've got a situation where Robert doesn't have to make a payment. He's adding a little bit to the loan each month, but he has grown his existing equity at the same rate. So that grows at the same time the property has appreciated more. So now down here, his net credit set aside is he can actually tap into $151,000. Last year was $120,000.
What can he do with that 151,000?
Great question. He can manage it in three different ways. It's a line of credit. That's why I said at the start, this is really just a glorified line of credit. He could take it all out and do whatever he wants. He could go to Vegas. He could take it out and a small lump, could take it out as a lump sum. He could also say, I want them to start kicking out to me like an extra $1,000 a month to help with income. So, he makes about $3,000 a month. Maybe he feels like if I could just get an extra $1,000, it would give me some peace. It would give me a better lifestyle to allow me to do things, right? Really important for seniors on a fixed income in a high inflation environment. He actually emailed me the other day and says, hey, I want to set this up. So we'll go and we'll set up $1,000. And in addition to the loan, it will actually pay him $1,000 each month. And you can just schedule it out so long as you don't go over that 151. So that gives him 151 months of $1,000 extra to live his life. All the while, any unused portion that he doesn't use continues to grow at the rate and the property still appreciates, so that access to your equity continues to grow over time. If he decided, hey, I don't like this mortgage at all anymore, he could pay down the entire mortgage and keep the loan in place. And now he would have 314, well, he'd have a line amount of $466,000 on his house, and he doesn't owe anything if he wanted to, and that would continue to grow at the 6.6%. So the best way to think about it is a really, really awesome FDIC insured line of credit. That's the best way to think about the reverse.
Well, I appreciate FDIC insured. This is interesting. And I can see the benefit of it. So I appreciate you walking me through this. I've got to go to an appointment, but I would be curious to know